Good evening, I'm Alessio, and welcome to tonight's Business and Finance Update. It has been a fascinating and volatile week on Wall Street, one that perfectly captures the push and pull between optimism and caution in today's markets. The stock market remains remarkably resilient, extending a rally that has surprised even seasoned investors. The S&P 500 closed October higher once again, marking its sixth consecutive monthly gain and standing up more than 16% year-to-date, while the Nasdaq has surged around 23%. But beneath those impressive numbers lies a tension. Investors are starting to wonder whether the rally's foundations are solid or simply built on lofty hopes, especially as we enter the heart of earnings season and stare down an uncertain Federal Reserve policy path. The resilience of equities has been impressive, but the numbers suggest caution. Corporate earnings for the third quarter are tracking nearly 14% higher compared to a year ago, a sign that American companies remain strong even amid global uncertainty. Yet the market's valuation multiple, now hovering above 23 times forward earnings, is sitting near levels last seen at the height of the dot-com bubble. That alone raises the question, are we repeating history? Analysts are saying that the next leg of the rally will depend less on hype and more on results. If companies can keep beating expectations, this momentum might continue. But if earnings start to disappoint, the air could come out of this market quickly. A huge part of this story, of course, is artificial intelligence. AI has been the spark behind much of this bull market's energy. The promise of automation, productivity gains, and data-driven innovation has investors pouring billions into tech companies. Every major earnings call seems to mention AI as a growth engine. But enthusiasm has limits. We've seen shares of giants like Meta and Microsoft fall after reporting strong results, not because their numbers were weak, but because they revealed even higher spending on AI infrastructure. Investors are now asking a critical question. When does this spending start paying off? The AI narrative has captivated the market, but as Business Insider noted, we may be seeing signs of a classic bubble dynamic forming, where valuations rise faster than the fundamentals can justify. And this is where the Federal Reserve enters the picture. Because in modern markets, the Fed is more than a referee, it's the central player. The Fed has cut interest rates twice this year, signaling confidence that inflation is cooling, but policymakers have also made it clear that the next move is not guaranteed. Chair Jerome Powell's latest comments suggested that a December rate cut is not a foregone conclusion. That uncertainty alone can swing markets. When rates fall, risk assets inflate as investors search for yield. When rates rise or pause unexpectedly, those same assets can deflate quickly. As Investopedia recently highlighted, the Fed's policies have the power to either inflate this AI-driven boom further or prick it entirely. Low rates and easy liquidity have always been the oxygen that feeds speculative fires. Take that away, and the air gets thin fast. So the big question becomes, how sustainable is this rally if the Fed steps back? We are now living in an environment where the market is priced for near perfection, low inflation, steady growth, rising earnings, and continued optimism about AI's transformative potential. But if any of those pillars wobble, sentiment can shift overnight. Investors are already operating in a data vacuum due to the government's delayed economic reports, so alternative indicators like private payroll data and consumer surveys are filling the gap. That creates volatility, and it also means narratives can move markets faster than facts. There's another element to consider: market concentration. Much of the year's gains have been driven by a handful of mega-cap tech stocks, the so-called Magnificent Seven. When a market rally relies so heavily on a few names, it becomes more fragile. One earnings miss or guidance cut from a major AI-linked firm can send ripples across the entire index. That's why analysts are watching the next wave of corporate results closely. Over 130 S&P 500 companies are set to report in the coming weeks, and their tone will determine whether investors keep believing in the story or start to pull back. The coming months will test several assumptions. First, whether rate cuts continue or pause. Second, whether AI spending starts translating into measurable productivity gains. And third, whether consumers remain resilient enough to support continued growth. Inflation has cooled but remains sticky in key sectors, and wage growth has started to moderate, suggesting the economy is losing some steam. That's not necessarily bad news. It could relieve pressure on prices, but it does mean the Fed will have to balance between stimulating growth and avoiding a fresh wave of speculation. If the central bank continues to ease, it may fuel more upside, but also greater risk of excess. If it decides to hold back, that restraint could trigger a repricing of the entire market. Business Insider pointed out that historically, more than half of all 10% market corrections since the 1960s have followed tightening cycles or a shift in rate expectations. That's a reminder that optimism can turn on a dime when liquidity tightens. So where does that leave investors today? In my view, we're in a phase of guarded optimism. The market strength reflects confidence in corporate America and belief in the transformative potential of AI. But the exuberance also reflects something deeper: faith that the Fed will keep the party going. That faith might hold, or it might be tested soon. The prudent investor right now isn't necessarily stepping away, but watching closely, keeping some dry powder, and remembering that markets, like technology trends, move in cycles. What feels unstoppable today can change quickly tomorrow. In the end, the story of this moment is a story of balance, between innovation and speculation, between growth and restraint, between the promise of AI and the hard reality of earnings and policy. The next few months will show whether this is a durable new phase of expansion or just another chapter in Wall Street's long history of overconfidence. Either way, it's a fascinating time to watch the intersection of finance, technology, and policy unfold. I'm Alessio, and that's your look at the markets tonight. Stay informed, stay cautious, and as always, keep your eyes on the fundamentals, because that's where the truth always hides.